What a beautiful day. And you know, that listener who complained last time that we were wrong?
Oh, yeah.
Still hasn't responded. I think we've been ghosted.
Well, maybe some people just want to complain rather than actually discuss things, and that's okay.
True.
Anyway, good morning, good afternoon, good evening, Sip&Talkers, wherever you are in the world, and welcome back to Sip&Talk.
Welcome back.
I have to bring this up. I was trying to grab a coffee yesterday, and I noticed the line at that huge, big brand coffee chain was insane.
Oh, the usual suspect.
Exactly. It was out the door, around the corner. But right next door, there was this independent coffee shop. It looked beautiful, really unique decor, but totally empty.
Oh, I know this story. So you thought, I'll support the little guy.
I did. I thought, great, I'll support the small business and I'll be fast. I went in, ordered, and the coffee was just inconsistent. Maybe great one day, but yesterday it was terrible. I ended up back in the corporate line this morning.
That is the perfect microcosm of what we're talking about today. I mean, it's literally the two systemic forces we're here to unpack.
How so?
Well, the big brand has the capital, right? They have the data, the streamlined supply chain, all of which means they can ensure consistent quality. And that attracts more and more customers.
So that's one side of it.
That is the Matthew effect in action. Success just breeds more success.
And my hope for the small shop. That thought that, next time they might figure out their bean consistency and finally start doing well.
That is your subconscious and very human desire for mean reversion. You want the system to correct itself, for the good quality to stabilize and bring them back to, an average competence.
Or maybe I should just stick to the baseline average, like the coffee we have here in the studio.
It's reliably average.
Let's table the coffee discussion for now.
Yeah.
Because I think today's Sip and Talk is going to be incredibly exciting. We're tackling two fundamental forces that act like the gravity of our world.
They really do. They shape finance, careers, even our coffee lines. So our mission today is to really crack the code on how the universe manages success and failure. We're going to examine two seemingly contradictory forces.
On one side, you have the Matthew effect, this thing that accelerates winners and concentrates resources, making the rich richer.
And on the other, you have mean reversion, which acts as the system's corrective anchor, statistically pulling all the extremes back toward the average.
And it is utterly fascinating because we see both of these forces operating at the same time across every single field.
Which leads to our core conflict for today. Is the universe fundamentally designed for stronger forever? Meaning that if you get ahead, you just stay ahead.
Or is it designed for you will be corrected, where every high, every peak must eventually snap back to some kind of baseline?
Okay, let's unpack this, starting with the one that sounds most powerful and arguably the most unfair, the Matthew effect.
Yeah, we often call it the law of accumulating advantage.
It sounds so formal.
Well, the term itself carries real weight. It actually originates straight out of the Bible, Matthew 25.29.
Oh, really?
Yeah, and the phrasing is stark. It says, "For to everyone who has, more will be given, and he will have abundance. But from him who does not have, even what he has will be taken away."
Wow. That is ruthless optimization baked right into a spiritual text.
It really is. And in modern academic and economic terms, we usually call this a cumulative advantage or just positive feedback.
So the basic principle is that having even a tiny initial advantage, it acts like momentum on a massive flywheel. It just makes it exponentially easier to get the next advantage.
And we see this playing out every single day, often hidden in the algorithms that, govern our digital lives. Just think about the massive social media paradox that frustrates every creator out there.
Oh, I know this frustration well. You're talking about the mega influencer paradox.
Exactly. Imagine a creator who's already huge, 10 million followers, big brand deals, the whole thing.
Right.
They could post a poorly lit, maybe even a half-hearted video of themselves just eating instant ramen, shot quickly on a phone with zero effort. And because they already have that established credibility and history, that video instantly gets pushed to the top of the feed. It generates millions of views, massive engagement.
And the platform algorithms love engagement, so they reward that creator with even more reach. It's a feedback loop.
Meanwhile, a dedicated newcomer, someone who maybe spent 3 weeks meticulously learning professional editing software, invested in a nice camera, deeply researched their topic, and made genuinely innovative content.
It's 10 views.
It's 10 views, maybe 11, if a family member watches it.
And the frustrating thing isn't the quality of the content, it's the structural advantage that the platform itself gives them.
Precisely. The algorithms are fundamentally designed for efficiency and engagement. and they prioritize the established giants because they're a known quantity. Their success automatically generates more success, which creates a widening gap.
That is the Matthew effect in real time.
Yeah.
So the key trend this whole thing generates then is divergence. The gaps between the successful and the struggling just widen steadily over time.
The rich get richer, the popular get more popular.
And the fast get faster until that starting line advantage turns into an absolute chasm.
Okay, so now let's bring in the necessary counterforce, the universal anchor, which is mean reversion.
This one sounds like the universe's way of ensuring some kind of justice, or at least statistical parity.
It's purely a statistical concept, but one that has these profound real-world consequences. It suggests that any variable, a stock price, an athlete's recent scoring streak, even the coffee from that shop you went to,
Right.
that deviates significantly from its long-term average or mean will eventually be corrected and snap back toward that average.
We could call this the school of hard knocks for systems. It's the natural mathematical correction mechanism that says extremes, whether they're positive or negative, just cannot be sustained forever without some kind of fundamental structural change.
Yeah, and the easiest example for most people to relate to is beginner's luck.
Oh, yeah.
You know, when you first start playing an intensive game like high-stakes poker, or maybe you try a new investment strategy, you might win big right out of the gate. You feel thrilled, invincible. You're convinced you're a genius.
Right, I've cracked the code.
But that initial massive win is a temporary, positive, extreme deviation.
And inevitably, if you keep playing, that high-flying win rate eventually reverts back to your true skill level, which is the actual mean performance you can sustain. That initial spike of luck was just statistically unsustainable.
And this statistical truth goes deep into human psychology and how we mistakenly attribute cause and effect. The Nobel laureate Daniel Kahneman wrote a lot about this.
Oh, the flight instructor study.
A flight instructor study. He detailed the study of Israeli flight instructors who observed that when they heavily criticized or scolded a cadet after a really poor landing, a negative extreme performance, the cadet's performance almost always improved on the very next try.
And so, what did the instructors conclude?
They concluded that scolding worked. They saw the improvement as direct evidence that negative reinforcement was an effective teaching method. They even developed an internal policy based on this faulty observation.
And this is where mean reversion becomes like the intellectual killer, because the instructors were fundamentally wrong about the cause.
Totally. The improvement wasn't because of the scolding. It was simply the cadet's performance, naturally returning from a negative extreme, that terrible prior landing back toward their average inherent skill level.
It was mean reversion in action, just mistaken for effective management.
And that's a crucial insight we have to carry through this whole discussion. So many people, whether they're investors or managers, constantly mistake this natural statistical correction for the successful result of their own intervention.
So the core truth here is convergence, the statistical inevitable return to the baseline average. So, okay, we have these two cosmic poles. One is pulling things apart, accelerating divergence, and the other is pulling things back together and forcing convergence. How can they possibly exist at the same time without, tearing the world apart?
That is the $64,000 question. And the core mechanism that determines which force dominates in any given situation. It really rests on two factors, the system's feedback mechanism and, maybe even more importantly, the time scale we're observing.
Okay, let's define those dynamics clearly.
The Matthew effect is almost entirely driven by structural advantage. So this means durable, self-reinforcing barriers to entry.
Like network effects, the bigger Facebook gets, the more valuable it is for everyone else to be on it.
Right, or a brand monopoly, like that big coffee brand's name recognition, or just vast capital concentration. And because these advantages are structural and they take time to build, this is inherently a long-term phenomenon. It plays out over years, decades, or even longer.
Okay, so Matthew effect is long-term and structural.
Right. Conversely, mean reversion is largely driven by random fluctuations.
So think unexpected news cycles, temporary emotional exuberance in a market, or sudden, short-lived supply-demand shocks.
Exactly. It's also the necessary force of market correction, when prices or emotions just get wildly ahead of the underlying reality. And since it's correcting these transient extremes, it's typically a short-term phenomenon. It often resolves itself in weeks or months.
Okay, to really get this, let's run a thought experiment.
I love when we get philosophical. Let's do it.
Scenario 1, a world where only the Matthew effect exists. Imagine that positive feedback loops are never interrupted. Momentum is eternal. What's the end game there?
It would be a pure winner-take-all ultimate black hole.
It's the dystopian vision of a cyberpunk reality. Just extreme concentration. You'd have one person or one entity that controls everything.
All the essential resources, all the money, the truly advanced AI, all the intellectual property.
And yes, even our moderately priced studio coffee would be a subsidiary of that one single entity.
Absolutely. Now, that system would drive unbelievable breakthroughs. It would achieve levels of excellence never seen before because the most successful teams or companies would just absorb all the talent and resources without limit.
But the societal cost would be total severe stratification, a complete lack of opportunity for newcomers or smaller players. Divergence would just go to infinity.
Okay, now for the terrifying counterpoint. Scenario 2. A world where only mean reversion exists. No lasting momentum. Every success is instantly yanked back to the mean.
That would be a world defined by extreme, perpetual mediocrity.
Right. Every effort, every investment in innovation, every burst of truly great artistic or scientific output is immediately and statistically pulled back to the average performance level.
So if you invented fusion power, that incredible breakthrough would be like functionally averaged out by next Tuesday, making the energy market just stable and unremarkable again.
You'd have no heroes, no lasting dynasties, no accumulated wisdom, just statistical stability.
And why would anyone even try to achieve anything great if they knew the rubber band of statistics would just yank them back immediately? It would kill ambition and risk-taking.
So this thought experiment really clarifies the critical distinction. The Matthew effect drives breakthrough and extremity, pushing the limits of what's possible.
While mean reversion ensures system stability and long-term equilibrium, it prevents total runaway inequality or collapse.
Exactly. When a phenomenon is built on structural moats, specialized skill, and high entry barriers, the Matthew effect dominates. When success involves a high degree of pure luck and short-term randomness, mean reversion takes over.
Okay, let's spend some extensive time on the Matthew effect, because this force is the engine of modern wealth and power concentration. It's literally where the money is.
It is the defining feature of the last 2 decades. I mean, the digital age hasn't just continued the Matthew effect. It has leveraged technology and connectivity to turn it into a hyper-accelerated force.
The data must be crazy.
The data supporting this concentration is truly startling. Get this. Bloomberg, in their 2026 analysis, highlighted a crucial data point.
Okay.
The global top 1% of companies, and we're talking about a very thin sliver of the corporate universe, they capture approximately 60% of the market's entire profit growth.
Stop and think about that. 60%. So tens of thousands of companies are out there fighting for a piece of the pie, but the overwhelming majority of the new growth flows only to a tiny entrenched handful at the very top.
Yeah, that indicates not just a slight advantage, but systemic structural dominance.
And this trend has been intensifying.
It has. Oxford Economics, in their 2025 report, confirmed that global wealth concentration has been dramatically exacerbated over the past 5 years, precisely because of the expansion of digital platform economies.
Because the mechanism is simple. A digital service has near zero marginal cost to scale.
Exactly. Once one company achieves dominance, they can instantly serve billions of people at negligible additional cost. And that turns that initial Matthew advantage into a massive global multiplier.
And the most compelling case study for this right now, the one everyone is talking about, has to be NVIDIA in the tech sector.
Absolutely. NVIDIA's story is the textbook definition of the Matthew effect becoming structural. Their initial advantage was simply having powerful AI chips, the GPUs, the graphical processing units, at the right time. But that hardware was only the first snowball push.
Right. The actual structural moat wasn't the silicon itself. It was the ecosystem they built around it.
Precisely. NVIDIA built the CUDA platform, which is their software layer, a framework that allows developers to efficiently program their GPUs. By getting this framework into every major university, every large AI lab, every cloud provider, they created a perfect feedback loop.
And that feedback loop means every groundbreaking piece of AI research, every major training model is fundamentally built on, optimized for, and dependent upon the CUDA ecosystem.
Which created massive switching costs. A competitor might build a technically superior chip, but if developers have to rewrite 10 years of proprietary code to switch to the new platform,
It just won't. It's too much work.
they won't. So NVIDIA's structural Matthew effect isn't just about hardware dominance. It's about software lock-in, community standardization, and a multi-decade head start in developer loyalty. It makes it nearly impossible for anyone to catch up.
Okay, and we can formalize this pattern using some established theories. Let's talk about the Lindy effect.
The Lindy effect, which Nassim Taleb popularized, is this intriguing application of Matthew principles to non-perishable things, ideas, books, companies, technologies.
And the theory states that the longer something has existed, the longer its expected future lifespan is.
Exactly. So the very fact that something has survived time becomes its accumulating advantage. If a major philosophical idea has been studied for 200 years, Taleb argues you can reasonably expect it to be relevant for another 200 years.
Time itself becomes the ultimate longevity moat. It implies that what has stood the test of time is robust and resilient.
But we have to acknowledge the criticism here because we aren't just here to cheerlead. The Lindy effect, while useful, can also mean we get stuck supporting outdated, entrenched systems.
Right. It rewards legacy simply for being old, which can sometimes stifle true innovation or a potentially better but newer system.
That's a great challenge. Lindy is about accumulating survival advantage, but innovation requires breaking existing models.
What's the second key model?
The second key model is preferential attachment. This comes straight out of complex network science, most famously the Beer-Bossi-Albert model.
It sounds academic.
But the principle is incredibly easy to understand in practice. It describes how links are formed in dynamic networks, like the internet or a social graph. New links, a new user joining, a new piece of information being shared, are vastly more likely to attach themselves to nodes that already have a ton of links.
They prefer the known winners.
Exactly.
This perfectly explains why those colossal social media accounts grow exponentially faster than a new one. As a new user looking for information on, say, investment strategies, you don't scroll down to the person with 10 followers.
No, you instinctively click on the account with 1 million followers. Instantly gives them another follower, further accelerating their growth.
So the rich get richer, not just in wealth, but in attention, in data, and in future access.
But this accumulation, as we hinted at earlier, comes with severe costs to the system as a whole. We have to talk about the negative consequences of the Matthew effect when it runs unchecked.
Right. The two big ones are the resulting class fixation and the reinforcement of dangerous information silos.
Yeah. If the algorithms are constantly and efficiently pushing only the hottest, most popular content, the stuff with established mass attention, it actively starves the long tail of diverse, niche, or genuinely new content.
The system becomes an echo chamber of its own success.
Exactly. And think back to that dedicated newcomer who spent 3 weeks editing their video. Their content never breaks through that threshold of initial attention because the system is designed to reward scale, not nascent quality.
This leads to what you called class fixation. People who are already established or wealthy find it easier and easier to maintain that status, while those outside the gate find the barriers to entry are constantly getting higher.
And this stifles diversity not just in content, but in thought. If you only ever hear the most popular voices, you are locked into an information silo.
So the system sacrifices intellectual variety for the efficiency of scale. The Matthew effect is fantastic for scaling proven excellence, but it's terrible at allowing genuinely diverse or challenging voices to break through the noise.
It locks people into existing structures, whether those structures are economic or informational.
Okay, it's clear that the Matthew effect creates an overwhelmingly difficult playing field for anyone who wasn't an early winner. Now, let's find some comfort in the counter mechanism. Mean reversion is basically Mother Nature and statistics combining to say the universe requires balance.
It's a beautifully powerful concept because its statistical governance reaches far beyond the financial world and into human biology, performance, and just everyday life.
Outside of finance, where do we see this correction most clearly?
The field of genetics provides the classic earliest example, which was studied by the statistical pioneer Francis Galton. He looked at heights. If you have two parents who are extremely tall, a huge positive extreme in the population, their children will certainly be tall, but statistically, they are highly likely to be slightly shorter than the parents themselves.
So the next generation is literally regressing toward the mean height of the wider population. It shows how difficult it is to sustain an extreme genetic trait across multiple generations without that mathematical pull of the mean-taking effect.
Exactly. Or consider performance and luck in sports, which leads us to the universally known phenomenon of the sports magazine cover curse.
Oh, this one is great.
Yeah. An athlete often appears on the cover of a major magazine right after achieving an unbelievable record-breaking performance, a statistical outlier event. And what often follows is a perceived dip in performance.
And the media suggests it's a curse, or maybe they got too complacent after the fame.
But the statistical reality is completely non-mystical. They appeared on the cover because they were performing at a statistical peak, a massive positive extreme that was far above their true average skill level.
So naturally, their performance has to revert to their normal, slightly lower mean level afterward. It's not a curse, it's just statistics making them sustainable again.
That reframing is key.
Yeah.
They remove the emotional narrative and replaces it with pure mathematics.
And mathematics is the bedrock here. The foundational model supporting mean reversion is the law of large numbers.
This is the probabilistic cornerstone we all learned about early on, right?
Yes. It states that the average of the outcomes from a vast number of repeated trials will approach the true underlying probability, the population mean.
For instance, if you flip a coin, you might, by random chance, get 5 heads in a row. But if you flip it 1,000,000 times, the average will stabilize precisely at 50% heads and 50% tails. The sample average converges on the true population mean over time.
Which perfectly sets the stage for the psychological trap that catches out so many investors and casual observers, the gambler's fallacy.
This is mean reversion's treacherous twin. The gambler's fallacy is the profound psychological error where people falsely believe that after a series of extreme random events, like those 5 coin flips resulting in heads, a necessary correction must occur.
They believe the 6th flip must be tails to statistically balance the mean.
Right. But they are mentally applying the statistical law of large numbers to a system, the coin flip, where every single event is completely independent. The coin doesn't have a memory of past results.
Precisely. And this highlights a crucial difference. Mean reversion corrects persistent systemic deviations that are based on underlying skill or valuation, but it offers absolutely no guarantee of balance in a purely random, independent sequence of events.
You have to know the difference between a system seeking parity and a random system with no memory.
Okay, let's pivot to the arena where these two cosmic forces truly go to battle, the stock market. You mentioned that current investors, especially in 2026, are really struggling with this distinction.
Oh, they are walking a tightrope. When the top 10 stocks in the S&P 500 index account for, 35% to 40% of the index's total market cap, that concentration isn't just high, it's a clear and potent display of the Matthew effect.
So the dilemma for every investor right now is separating that Matthew-driven, genuine structural growth from a mean reversion-bound bubble that's driven purely by speculative hype.
It's the essential difference between true, fundamental momentum and just pure, unsustainable emotional speculation.
Right. So let's analyze the Matthew effect in finance, which we define as the momentum strategy. This only happens in industries with structural moats, high capital barriers, network effects.
Like the leaders in AI infrastructure.
And for this to be a genuine Matthew effect and not just hype, the price increase has to be driven by verifiable, high earnings per share EPS growth.
Meaning the profits are actually flowing, not just people feeling excited about the future. The growth must be fundamental and structural.
So if you're looking for technical indicators to confirm this Matthew effect momentum, what do you look for?
You need to observe sustained strength. The Relative Strength Index, or RSI, which measures recent price momentum, needs to be consistently elevated. We're talking in the 60 to 70 range.
Okay.
This indicates robust buying interest, but it hasn't yet reached that traditional overbought extreme of 80 or 90 that usually signals an immediate, sharp mean reversion is coming.
And then there's the simplest indicator of long-term trend strength.
The stock price needs to remain consistently and resiliently above the 200-day moving average, 200 MA. The 200 MA is the fundamental benchmark for long-term health. If the stock consistently finds support there and keeps heading higher, that's resilience. That's the Matthew snowball gaining density.
What about one more?
A final key metric is the Average Directional Index, or ADX. This measures the strength of the trend, not the direction. For true Matthew effect strength, the ADX should be high, typically over 25, confirming the trend is undeniable and powerful.
And given the 2026 context, this Matthew effect for the tech sector leaders is heavily supported by economic forecasts. I think Goldman Sachs reported in 2026 that AI, supercycle-driven corporate earnings are expected to keep driving exceptionally strong growth.
Yeah, something like 13 to 15% over the next 2 years for key sector players.
Yeah.
And that actual measurable profit growth is what solidifies and reinforces the structural advantage, making the Matthew effect look durable.
Okay, now let's look at the flip side. Mean reversion in finance, what we call the value correction strategy.
This is the painful process of the rubber band snapping back, because the run-up was driven by something transient.
And the core feature here is that the price increase is driven purely by PE, price-to-earnings expansion.
Right. This means the valuation, often expressed as the PE ratio, has inflated far beyond what the underlying fundamental earnings can possibly support. The price is running away from the actual profits, purely fueled by market psychology and emotion.
So how do we spot that statistical extreme that signals the system is about to correct itself?
Visually, we use Bollinger Bands. These bands define a stock's historical deviation range. When the stock price is far from its moving average, the bands widen. And if the price persistently touches that upper rail, it often suggests a temporary statistical extreme that must revert.
But the mathematical gold standard is the Z-score, or standard score.
Can you remind us what the Z-score is, just conversationally?
Yeah, sure. The Z-score tells us how many standard deviations the current price is away from its historical mean. If a price deviates more than 2 standard deviations from its long-term average, so a Z-score greater than 2 or less than -2, it is statistically highly improbable for that extreme to be sustained.
It's a powerful warning that a reversal or correction is imminent. You are statistically at an extreme, and the system is engineered to pull you back.
And we are seeing tangible evidence of this statistical imbalance right now. Invesco noted in 2026 that the equal weight S&P 500 index, where every stock in the index counts the same, is significantly underperforming the standard market cap weighted index.
And this huge disparity confirms that only a handful of giants are carrying all the weight, creating a massive imbalance. A future mean reversion correction is highly likely to manifest as a flow of capital out of those extremely concentrated, highly valued giants and into the undervalued, equal-weighted midcaps.
It's the market seeking statistical balance through capital reallocation.
So here's the critical investor's warning, the central takeaway for this section. You cannot use mean reversion logic to trade Matthew effect assets.
This is where most amateur investors get burned. They look at a truly dominant Matthew-driven stock and they say, it's too high, it must come down. They're mistaking structural advantage for temporary hype.
You have to observe the duration. A temporary deviation due to a random news hype cycle. That is mean reversion territory, and the rubber band will snap.
But continuous structural outperformance, a company delivering yearly EPS growth far above the sector mean for 5 consecutive years, that is the Matthew effect snowball rolling, and shorting it based on mean reversion logic is a guaranteed way to lose your shirt.
And we also have to heed the systemic warning from institutions like BlackRock in 2026. They suggested we are definitively shifting from what they called a gambler's market, where hype and speculation ruled,
to a much more rigorous investor's market.
And the driver of that shift is higher, more sustained interest rates. High rates raise the cost of capital and immediately expose poor business models.
So companies that are merely Matthew followers, the ones riding the general sector wave without a true structural advantage or profitability, they will find themselves exposed and eliminated by mean reversion.
The higher interest rates act as a catalyst for statistical correction. Only the companies with genuine, durable moats, the true Matthew leaders like NVIDIA, will survive that inevitable mean reversion phase.
Okay, let's pivot to a concept that has been universally lauded, often cited as the world's 8th wonder, compound interest.
Right, often attributed to Albert Einstein. But recently, particularly among younger, highly informed online communities, skepticism is growing. They're asking, sometimes provocatively, if the idealized version of compounding is the biggest financial trap of the century.
The paradox is immediate. Compound interest, or ETCHA, is mathematically true. I mean, the concept of exponential growth is undeniable. If I invest $100 and it grows 10% a year, the second year I earn interest on 110. It works. So how can it possibly be a scam or a trap?
It's not a mathematical scam. It's a real-world deception that's rooted in survivorship bias and the debilitating friction of the modern economy. The models are pristine, but the real world is messy, volatile, and expensive.
Okay, so let's dissect the 3 fatal flaws in the idealized compound interest model that's often sold to young people.
Fatal flaw number 1, inflation and friction costs.
The standard compounding charts and calculators, they all assume net growth. They tell you that a 7% annual return is what you get.
But in our current economic environment, which is marked by fluctuating but often high inflation, combined with rising financial friction management fees, brokerage costs, frequent tax law changes that force costly reallocations, that compounding engine is constantly hitting sand.
Right. The Economist made a compelling argument recently, pointing out that if you meticulously deduct the actual decline in purchasing power due to persistent inflation, and then layer on management fees and taxes,
the real, true inflation-adjusted growth rate of many long-term compounding products often approaches zero, or sometimes even becomes negative.
So you look like you're accumulating paper wealth, but in terms of actual purchasing power, you are essentially just running on a very expensive treadmill to stay in place.
And fatal flaw number 2 is perhaps the most brutal realization: survival risk and black swans.
To realize the magic of compound interest, that exponential curve, it requires an extremely long duration, typically 30, 40, or even 50 years.
Which necessitates that your chosen asset or portfolio has to survive, consistently producing positive returns for that entire period.
And here's the cold, hard data that undermines that premise. The average lifespan of a company in the S&P 500 index, the proxy for the stable, large-cap economy, has plummeted.
From over 30 years in the 1960s to less than 15 years today.
Wow.
The modern economy is defined by rapid disruption. It is increasingly difficult and statistically improbable to maintain a single asset or a focused strategy for the duration necessary to experience the true power of compounding without serious constant friction.
Companies die, industries are rendered obsolete overnight by technological shifts, and unpredictable black swan market crashes happen frequently enough to reset the clock.
And the friction of just managing that inherent risk, the constant need for monitoring, strategic switching between assets, forced rebalancing, that itself further reduces the actual compound return you realize in your pocket. You pay for the supposed stability with lower returns.
Okay, and finally, fatal flaw number 3, which directly challenges the foundational advice given to every young graduate: the opportunity cost trap.
This is the powerful critique of excessive early saving. Traditional financial wisdom tells us view A, save $500 today at age 20, and compounding makes it a huge nest egg by age 60, thanks to the magic of time.
But view B, which is gaining a lot of traction, argues that the $500 spent at age 20 on something that generates self-growth compound return could be vastly more valuable.
Like what?
That $500 could be spent on high-value education, certification, specialized skills, essential travel that expands your horizons, or, crucially, early-stage entrepreneurial experience and high-value networking.
That's a radical thought.
Yeah.
When you are young, your human capital, your ability to learn and adapt is your highest return asset. Investing in that might yield returns that far outweigh the modest 7 or 8% return in a safe index fund.
The data suggests this nuance is real. A 2025 report by Jonte analyzed career trajectories and found that young people who overinvested early in what they termed defensive compounding,
Just purely saving safe money for the long term.
yeah, they often saw lower total career income growth compared to those who prioritized high-risk, high-return personal skill acquisition or early career mobility. They traded immediate financial safety for limited long-term earning potential.
So compound interest isn't fake, but the ideal mathematical model fundamentally ignores the real-world costs of time, risk, and the lost opportunity to maximize human capital when you are most flexible.
It is not a mathematical scam, but it is certainly a powerful marketing oversimplification that ignores life's inherent complexity and the volatility of the Matthew effect economy.
Okay, now that we've thoroughly pulled these two gravitational forces apart, the accelerator and the anchor, the goal is to synthesize this knowledge and provide a roadmap for navigating this chaotic world.
First, we need absolute clarity on where each force applies in our lives, recognizing that we can often choose which force we want to harness.
Right. In personal growth, you must actively pursue and cultivate the Matthew effect. Don't rely on random luck or hope for mean reversion to lift you up.
You need to build a small, defensible initial advantage, a unique skill tag, a specialized knowledge base, a powerful network, and then use consistent effort to let time roll that snowball.
Preferential attachment favors the person who is demonstrably better at one niche thing than 90% of everyone else.
In times of lows, this is where you harness the comfort of mean reversion. If you are currently in an extreme low point in your career, in a business cycle, in a project statistically, the next move is more likely to be upward toward your long-term average competence.
It's the most rational and powerful argument against falling into despair. Trust the statistics, not the temporary emotion.
Then, in investment, this demands the ultimate balancing act. Use mean reversion logic to spot genuinely undervalued opportunities. This is the foundation of value investing. You look for prices that have deviated far below their historical fundamental mean.
Representing a temporary dip, not structural failure.
But then you have to critically use Matthew effect logic to identify assets with genuine structural advantages. The companies with deep moats, powerful network effects, and clear positive feedback loops, like the NVIDIAs of the world.
But you must always be hyper-aware of the accompanying valuation bubble, which is mean reversion, just waiting to happen if the growth stalls.
So the ultimate success formula combines these ideas. Truly successful individuals use Matthew effect principles, preferential attachment, accumulation, to build that initial structural advantage and create a moat that prevents easy competition.
Then, they leverage the Lindy effect to ensure that advantage persists and is constantly reinforced over decades.
And the crucial element for maintaining that success is staying hyper-vigilant against the complacency that always precedes a mean reversion correction. They never assume their peak performance is their average performance.
They adapt, innovate, and diversify their advantage before mean reversion forces them to. They understand that the minute they stop innovating, the market's statistical pull will begin to work against them.
But here's the necessary counterbalance, the crucial fact check to end our analysis. The Matthew effect's power, as dominant as it is right now, is not unbreakable.
No. The economists observe that extremely rapid tectonic technological shifts, like the sudden massive jump in focus from the Web3 and crypto hype to the immediate practical application of generative AI, can instantly and violently dismantle existing cumulative advantages.
So that new wave doesn't care how big your existing snowball was. If the entire landscape and the underlying mechanism for generating profit change completely, that decades-long structural advantage can just evaporate.
The 1% must constantly, ruthlessly innovate just to maintain their edge. The battle between the Matthew effect and mean reversion never truly ends.
This has been a deeply thought-provoking discussion on the foundational structures of the world, and we want to affirm that our goal here is the objective reporting and analysis of these economic and scientific principles.
Right. We're promoting critical and independent thinking, helping you understand the forces at play without criticizing or discriminating against any group.
And understanding whether the force acting on you right now is a powerful momentum engine or simply a statistical correction mechanism. That's the crucial step toward finding your successful path in an increasingly chaotic world.
So we talked extensively about how the Matthew effect favors cumulative practice and building a long-term advantage.
Yeah.
That emphasis on sustained, dedicated effort makes me wonder about something related that is often cited as the key to mastering any field.
What stands out to you as a follow-up?
If accumulated effort and advantage is the engine, maybe next time we should explore the famous and highly debated 10,000-hour rule. It's dedicated practice, the ultimate verifiable engine of the Matthew effect.
Oh, that provides a perfectly provocative framework to end on, analyzing whether excellence is a product of accumulation or simply a statistical outlier.
We urge all of you to subscribe to Sip and Talk wherever you listen. Don't forget to look for us every week.
And please check out the content from our old friend Mickey on his YouTube channel, Mickey to Life. He always posts some genuinely entertaining travel vlogs, and I've been noticing the quality of his video production and storytelling has jumped significantly lately.
I agree. Mickey's content feels way more polished, more structurally competent than it used to. It shows serious cumulative effort.
Is that the 10,000-hour rule starting to pay off, Mickey? Everyone, go check out his videos and tell us what you think.
We'll see you next time on Sip and Talk.
Bye.